Welcome to Voich Daily Finance, the most important news personalized for you every day. Supported by Voich.com.
After listening to today's news, you'll know first, Ken Griffin warns sticky 3% inflation will crush dovish market hopes, calling for Fed independence amid political pressure. So we'll discuss why this hawkish inflation forecast clashes with market expectations and what it means for the future of Fed rate policy. Second, US jobless claims plummet and GDP surges to 3.8%, creating a massive disconnect with the Fed's recent rate cut. We'll explore how this wave of blockbuster data challenges the Fed's dovish pivot and what it signals for investors pricing in more rate cuts. Third, a fear-driven boom hits the US auto market as buyers rush to avoid tariff hikes and a $7,500 tax credit cliff. This discussion will reveal how this pull-forward demand creates a temporary sales boom and why it could lead to a sharp collapse later. A warning shot just fired on Wall Street. Billionaire investor Ken Griffin says the inflationary impact from tariffs is not over. In fact, he believes only half of it has even passed through the economy. A while back, we analysed research from the 2018 to 2019 period, showing tariff pass-through to consumer prices was only moderate. The latest development is Griffin arguing the remaining slower-moving effects are still in the pipeline. Griffin's point centres on the delayed or second-round effects of tariffs. You see, the full impact isn't immediate. It takes time for higher import costs to work their way through the entire supply chain and show up as higher prices on store shelves. Recent upward revisions to official CPI data confirm this, suggesting that initial estimates may have underestimated these tariff-induced price pressures. This challenges the popular narrative that goods inflation is disappearing, and it's a key reason why inflation might prove to be much stickier than many people expect. That nuance also helps reconcile why, as we discussed before, earlier data seemed to show little broad inflation from tariffs, yet the revised numbers and second round effects now tell a different story. For our listeners in the Chinese-speaking world, this has a direct implication. It all comes down to whether Chinese exporters can absorb the extra costs. China's Producer Price Index, or PP, has been in deflation for nearly 3 years, which means prices at the factory gate are falling. This suggests that due to weaker demand at home, many Chinese companies are choosing to absorb the tariff costs themselves to maintain their market share in the US. This is temporarily muting the inflationary impact for American consumers, but it comes at a great cost, squeezing the profits of Chinese industrial firms and potentially impacting investment and employment in China. As we flagged a while back, if China's producer prices stop falling and exporters can't keep absorbing those costs, that hidden inflation could surface quickly and catch a dovish market off guard. His forecast, inflation will stick in the mid 2 to 3% range next year, remaining stubbornly above the Federal Reserve's 2% target. Griffin's direct words were a stark reminder of the stakes, stating, "I would not underestimate how grating a 3% inflation rate could be to tens of millions of American households." And that's a big deal because when people feel the pinch from persistent inflation, they tend to pull back on discretionary spending, things like dining out, travel, and big ticket purchases. Research shows that a sustained inflation rate around 3% can breach a psychological threshold for consumers. The University of Michigan's Consumer Sentiment Index, a key leading indicator, has already started to fall, signaling growing concern. This consumer inflation fatigue poses a real downside risk to economic growth forecasts that are counting on the American consumer to keep spending, but don't expect the Fed to ride to the rescue. While the market has been signaling more aggressive easing, Griffin predicts only one more quarter-point rate cut from the central bank this year, with just an outside chance of a third. This puts his forecast in direct conflict with broader market expectations. Continuing our last discussion about that rare dovish descent on the FOMC, which leaned on the idea that tariffs are a relative price shift rather than a driver of broad inflation, Griffin is staking out the opposite, more hawkish end of the spectrum. Here's where it gets interesting. The gap between Griffin's hawkish view and the market's more dovish pricing is setting the stage for potential fireworks. This is what experts call a policy rate divergence. The key here is that if economic data continues to show sticky inflation, the market may be forced to rapidly reprice its expectations to align with the Fed's more cautious stance. Such a sudden shift could trigger a sharp correction in assets that are sensitive to interest rates, like technology stocks and long-term government bonds. And remember, as we noted a while back, dovish descents at the Fed are historically rare, adding another layer to why this divergence matters. But that's not the whole picture. The real heart of Griffin's message is a powerful defense of the Federal Reserve's independence, pointing to past political pressure and the risk it poses to the economy. His timing is no accident. History gives us a very clear warning. In the early 1970s, the Nixon administration pressured Fed Chair Arthur Burns to keep interest rates low ahead of an election. The result was a period of runaway inflation and economic instability. As we've discussed before, even the perception of political interference can have a cost. It can increase what's known as the US sovereign risk premium, which is the extra return investors demand to hold US debt. A higher risk premium means higher long-term borrowing costs for everyone, tightening financial conditions and complicating the Fed's job. The conflict is stark. The Fed is already struggling to balance its goals of stable prices and full employment. Now, it faces the added challenge of maintaining its authority. Griffin's final point is the most critical. If a president is perceived as being in control of the Fed, the central bank's ability to make those painful but necessary decisions for the economy is fundamentally compromised. We just heard Ken Griffin's hawkish take on inflation. Now, let's shift to the real-time economic data, which, believe it or not, is telling a completely different story. Just 1 week after the Federal Reserve cut interest rates, citing rising risks to employment, the labour market just fired back with a massive surprise. A while back, we said that first cut looked more like a warning shot than a victory lap, and today's twist confirms it. Initial jobless claims didn't just fall, they plummeted to 218,000, shattering estimates of 235,000 and pouring cold water on fears of a weakening job market. The situation presents a fascinating duality. We previously analysed how the Fed was pivoting toward preventing a sharp rise in unemployment, but initial jobless claims, which track layoffs in real time, are telling the exact opposite story. This suggests the Fed might be making a policy error, focusing too much on slowing hiring data while ignoring the fact that companies are simply not firing people. Interestingly enough, this might be a sign of a phenomenon called labour hoarding. After the massive hiring challenges following the pandemic, many companies are now extremely reluctant to let go of their staff, even if business slows down. They'd rather hold on to their employees, fearing they won't be able to rehire them later. This keeps the number of people filing for unemployment benefits surprisingly low and complicates the Fed's job because it can lead to stickier wage growth and inflation. If that was just the appetizer, the main course is just being served. The economic data is practically shouting. The broadest measure of economic growth, GDP, was just revised up to a stunning 3.8% gain for the second quarter, driven by a surge in consumer spending. That same consumer spending, the engine of the nearly 30 trillion US economy, jumped 2.5%, crushing the previous 1.6% estimate. Still, we have to ask ourselves, is this strong consumer spending a sign of future strength, or is it just a look in the rearview mirror? After all, this spending surge in the second quarter might have been fueled by the last of the excess savings people built up during the pandemic. If that savings buffer is now gone, we could be heading for a consumer spending cliff, which would mean the Fed's caution is actually justified, despite the strong historical data. And the string of positive surprises doesn't stop there. Orders for long-lasting durable goods were forecast to decline by 0.4%. Instead, they surged 2.9%. One fascinating theory behind this surge is something called investment front-loading. Some analysts believe US firms are rushing to buy equipment and upgrade their facilities now in anticipation of potential new trade restrictions with China. For a Chinese-speaking audience, this is a key trend to watch. This decision brings both a temporary boost to US economic growth and comes with the inherent risk of signaling a longer-term strategic decoupling that will reshape global trade for years to come. This creates a major standoff. The Federal Reserve's official statement warned of downside risks to employment. Fed Chair Jerome Powell himself just called the current policy modestly restrictive. Yet even the weakest spot in the economy, housing, is showing new life, with sales of newly built homes soaring 20.5% in August. And remember, we noted a while back that the Fed's dot plot was all over the map. Today's upside surprises are exactly the kind of data that can widen those internal divisions. Despite all of this, markets are still expecting the Fed to cut rates twice more this year. Investors still see more easing ahead, while a tidal wave of blockbuster economic data is telling a completely different story, creating a massive disconnect between policy expectations and reality. This data war puts the Fed in an incredibly difficult position. If the economy is truly as strong as this data suggests, cutting interest rates further could reignite inflation. This would likely be negative for the stock market, as it would mean the era of easy money is truly over. Conversely, it could push bond yields higher. As we've emphasized before, the key focal point to watch now will be the next non-farm payrolls report. That will give us a clearer picture of whether the labour hoarding is holding firm or if cracks are finally starting to appear in the job market. This report is for informational purposes only and does not constitute investment advice. Market data is subject to rapid changes. That disconnect between the Fed's worries and the strong data brings us perfectly to our next story. We're seeing another market distortion, this time in the auto industry, driven by a completely different force, fear. Cox Automotive just raised its 2025 forecast to a massive 16.1 million new vehicles, a jump from previous estimates, as sales are already running 4.6% ahead of last year's pace. But this isn't about a thriving economy. From a macroeconomic perspective, it's a classic case of pull forward demand. It's when consumers accelerate future purchases into the present, not because they suddenly have more money, but because they anticipate negative changes like policy shifts or price hikes. So this isn't a sign of fundamental economic strength. It's a temporary distortion driven by anxiety, with consumers rushing to buy before potential tariffs hit. Now, get this. The buying frenzy was supercharged by a surge in EV sales as shoppers scrambled to grab an up to $7,500 federal tax credit before it gets eliminated. This created what economists call a subsidy cliff. According to JD Power, the share of EVs in retail sales skyrocketed to a record 12.2% in September because the reconciliation bill passed this year will end the federal clean vehicle credits for any vehicle purchased after September 30th. This sets up a crucial test for the EV market. Once the subsidies are gone, we'll see the true organic demand for electric vehicles. According to a Cox Automotive senior economist, the threat of future higher prices is leading many potential buyers to purchase sooner rather than later. And this threat is very real. The thing is, automakers have a limited ability to simply absorb the costs of new tariffs. Historical data from the Federal Reserve shows that even a 10 percentage point tariff on Chinese imports led to a roughly 4% increase in the prices of those goods for consumers. If broad auto tariffs are implemented, new vehicle prices will almost certainly become a source of inflationary pressure next year. But this market distortion isn't lifting all boats. It's creating clear winners and losers. One analyst put it bluntly, the biggest are getting bigger, while smaller and more specialized brands are stalling or losing share. What's really happening here is a fundamental market shift in real time. Economists use a metric called the Herfindahl-Hirschman Index, or HHI, to measure market concentration. The US Department of Justice considers a market with an HHI over 1,800 to be highly concentrated, and recent data shows the auto industry has now crossed that threshold. This suggests that in today's uncertain environment, sheer scale is becoming a more powerful competitive advantage than specializing in a niche market. General Motors is emerging as the biggest winner, projected to gain a full percentage point of US market share. Toyota, Hyundai, and Ford are also gaining ground, but the story is starkly different for others. Smaller car makers like Nissan, Volkswagen, Subaru, and even Tesla are all estimated to have lost market share. Meanwhile, Jeep parent Stellantis continues to struggle amid a years-long sales decline. This pull ahead in sales has created a short-term bonanza, but experts warn it's a sugar rush. The key here is to watch the sales data for the fourth quarter of this year and early 2026 very closely. Because this pull forward of demand has been so intense, analysts are forecasting a potential sales air pocket, a sharp, sudden drop in sales once the incentives are gone and the early buyers are out of the market. This could be a negative surprise for future GDP and retail sales data. The blistering sales pace is expected to slow significantly as the tax credits expire and tariff costs get baked into prices. This isn't a sign of a sustainably strong market, but a massive fear-driven distortion where the industry's giants are capitalizing on the chaos while smaller players get squeezed.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.